It's the most aggressive monetary tightening since 1981. The US Federal Reserve raising interest rates by 75 basis points. And it's the fourth rate hike this year. The US Central Bank is battling to tamp down on raging inflation, which is running at its fastest for 40 years. European markets reacting to the news today, leaping in the morning to their highest level in 7 weeks. That's after the chairman of the Fed predicted future rates rises would be less aggressive than previously thought. Here's what he had to say.
We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later.
Well, who better to break this down for us than Jörg Kramer, Chief Economist at Commerzbank. Thank you very much for joining us, Jörg. First of all, your reaction to this rate rise?
Well, this rate hike by 75 basis points yesterday was expected by us, expected by the market. And it was also clear that the central bank would not announce explicitly a further 75 basis points increase. This is clear. Instead, the Fed said this is data dependent, and I expect the next step to be 50 basis points.
OK, and looking at the broader picture, the theory of some experts has been that we need a recession to break the fever of high demand, to get out of inflation, or that at some point it's unavoidable anyway, so let's get the tough cleansing period out of the way. What do you say to that?
Well, I think we do not need necessarily a recession, but I think you have to be ready to take the pain of a short-term recession in order to bring down the inflation. As the Chairman Powell said during the press conference, the lessons of the 70s, if you always look at GDP and would like to avoid any recession at any price, despite a high inflation, then you risk that over the time the inflation problem gets bigger and bigger, and then in the end you are forced to hike interest rates. We saw this at the start of the 80s, when the Fed was forced, after 15 years of high inflation, after 15 years of too loose a monetary policy, they were forced to hike interest rates to nearly 20% and to cause 2 recessions in a row. And this was a big price to pay simply because the Fed waited too long. Therefore, I think the Fed is right what they're doing.
OK, some lessons from the past there. But you know who my thoughts and prayers are with at this particular time are the central bankers of the ECB, but also with businesses with significant exposure to dollar debt at this moment. So what should Europeans be making of this?
Well, as far as the ECB is concerned, the ECB also has a deep inflation problem, and the ECB always looks at Italy, highly indebted. But the ECB should more follow what the Fed does and to deliver more rate hikes. I think 150 basis points rate hike by the ECB, bringing the deposit rate to 0.0%, is not enough. We need much more rate hikes. I think in the end, the ECB has to come to a level of, I would say, 4% or so in order to bring down the inflation. And this is a mandate of the ECB.
OK, so the ECB has got some catching up to do with the Fed, says Jörg Kramer from Commerzbank. Thank you very much.
Thank you.